Hello, my name is Michael Morey. I'm a financial advisor with Morey & Quinn Wealth Partners based in Omaha, Nebraska. We are an independent branch of Raymond James Financial Services who are based in St. Petersburg, Florida. Today we're going to spend some time discussing the basics and the fundamentals of investing and retirement planning to help you build up your nest egg towards retirement. At the end, we're also going to go over the investment options that you have to choose within the state plan and hopefully help you decide what's the best allocation and investment choice for you. If you look at this first slide, it shows the different rates of return going back to 1926 between stocks, small stocks and large stocks, government bonds, treasury bills, and the rate of inflation. As you can see, over time, stocks, both small and large, have outperformed government bonds and treasury bills. However, you'll also see on the chart, there's a lot of ups and downs, good days and bad days throughout those years. The lines just don't go straight up. If you then compare it to the government bonds and treasury bills, you can see the average rate of return is significantly less than that of stocks, but the ride is smoother. There's not as many zigs and zags and ups and downs over time with bonds. And then you can see inflation and how it compares to the rate of return with the other investments. The next slide shows how the average investor compares to different asset classes as well as the S&P 500 or the overall broad market. As you can see, the S&P 500 going back to 1999 has averaged a rate of return of just over 6%. Conversely, average investors like you and me have averaged a rate of return of 2.5%. So we're going to go over some whys and hows of why the average investor tends to underperform the overall market, such as knee-jerk reactions and having no strategy at all. One of the reasons the average investor tends to underperform the overall market is because we try and time the market. We don't like it when the market has bad days, so we try and stay out of the market during those days and get back in during the good days. It's well and good in theory. However, if you look at this chart going back to 2000, just to the last 19 years, if you'd invested $1 in the year 2000 and left it invested the entire 19 years, your $1 would now be worth $3.24. Conversely, if you had tried to time the market and missed the best 11 months, less than 1 year out of those entire 19 years, your return, your $1 would only be worth $1.28. It cuts your rate of return basically in half. And the rate of return wasn't as good as treasury bills. You're not keeping up with the rate of inflation or government bonds. If we go back even further to 1926, and you invested $1 in 1926 and left it invested for the entire 93 years, your $1 would now be worth $9,244. Conversely, if you tried to time the market, get in when it's good, get out when it's bad, that same $1 would only be worth $21.47 if you had missed the best 51 months out of 93 years. So again, nobody has a crystal ball. If they tell you they can predict what the market's going to do from one day to the other, don't believe them. Nobody can do it. This next chart also shows the dangers of trying to time the market. Essentially, if you'd missed the 20 best days going back to 2000, from 2000 to 2019, being out of the market for just 20 of the best days, your rate of return is essentially zero. If you'd missed just the 50 best days from 2000 to 2019, you would have a negative return of 5.5%. Again, don't try to time the market. There's good days, there's bad days, but history has shown us that over time, the markets tend to perform. This last chart, again covering market loss over time and trying to time the market, simply shows the percentage, the rate of success, or the chances and the odds of having a positive year in the stock market. On a 1-year return, you have a 73% chance of having a positive return. Okay, well, if you're in a long-term investor, I'm more worried about the 5-year return and the 15-year return. Over a 5-year span, you have an 87% chance of having a positive return in the market. And going back to 1926, over 15-year periods, there is a 100% chance that you will have a positive return in the market. Now let me stop and be clear. There are no guarantees in investing. Every investment has a risk involved with it. But history has shown that over longer periods of time, your odds of having a positive return improve dramatically than trying to just judge your returns based on a 1 day or 1 month or 1 year average. Now let's talk about what's the difference between the average investors like you and me. What do we do differently versus the pros that tend to do it better than the average investor? For one, average investors make emotionally driven choices. We get it. Money is an emotional thing. We don't like getting our statements every month and seeing that we have lost money in the market or our values are down. That tends to make us make emotionally driven choices like selling at the bottom or buying at the top. Pros, on the other hand, have a plan in place. They're not worried about day-to-day returns, month-to-month returns. They have a plan and they stick with it, and they don't make knee-jerk reactions. Amateurs tend to have a haphazard approach. There's no real plan. They want to buy the hot stock, or they get a tip from a magazine or a talking head on TV, and they want to buy that, not paying no attention to whether that investment is appropriate or fits in with their overall objective and other investments. Pros tend to rebalance their plan. So they have a structure in place, and if one investment or one asset class tends to do really well 1 year, they'll rebalance, take some profits off the table, and spread those profits among the rest of their investments. Amateurs tend to react and make decisions with fear and greed. When the markets are bad, like in 2008 in the financial crisis, we react with fear. We tend to make the wrong decisions at the wrong time, selling at the bottom of the market, and conversely, we react with greed when things are doing well. We buy stocks or investments, mutual funds, what have you, at the highs when it should be flip-flopped. Buy low, sell high, but since it's an emotional, money is an emotional thing, we tend to do the opposite. The pros have a risk-reward analysis. They scour investments, they look over their plan and then say, how much risk are we willing to take on for a certain rate of return? And if the risk is too much and it's not worth the rate of return, they avoid the investment. They know how much risk they're willing to take. And this goes back to, as amateurs, we have a haphazard approach. We may not know what our risk profile is. We may not know what our time horizon is, and we can't make educated decisions if we don't have some fundamental things in place first. Again, amateurs try and time the market. We try and guess when the market's going to be good and be invested during those times and take our money out when times are bad. And typically by the time you've made those decisions, you're already too late. The pros have a diversified portfolio. They have different asset classes, which we'll discuss here in a little bit. Basically, for the sakes of this discussion, the 3 asset classes that we really need to focus on are cash, stocks or securities, and bonds. And there's some subclasses of those, but we're going to focus on those 3 for the sake of this discussion. But really, professionals have a blend of all 3. And they determine what blend is appropriate for their risk profile and their time horizon. Nobody should ever be 100% cash, nobody should ever be 100% stock, and nobody should ever be 100% bond. You need to have a blend of all 3 in some form. It's just determining what's the most appropriate for you as an investor. Now we're going to discuss some fundamentals of investing to help you build your investment profile, to know who you are as an investor, what kind of risk tolerance you can tolerate, and your time horizon to really help you make good, educated investment decisions. The first thing to know as an investor is, what's your time horizon? Different time horizons have different risks involved with them and should have different investments. If I needed money to invest to buy a house in the next 2 years, I'm not going to take on as much risk with my investments as I would if I'm building for retirement, which is 30, 35 years out. So we really need to hone down our time horizon to help build our investor profile. The next is to identify your risk tolerance. Are you okay with taking on risk? Can you stand some volatility? Or do you watch the news every night and get worried when you see the stock market's down? Do you lose sleep at night when you look at your statement and see that you've lost money this month? If that's the case, you probably shouldn't be taking on quite as much risk as a more aggressive investor. So that's something we really need to figure out to make sure that you are invested appropriately for you. Nobody's the same. Everybody is different. Identify your investor profile. Are you a long-term investor? Do you like bonds? Do you like stocks? What's your time horizon and how much risk can you afford to take? That's really your investor profile, which we'll go over. And the last step is to find an appropriate asset allocation mix. We touched on this briefly earlier, but what is the right blend for you between the asset classes, cash, bonds, and stocks? It's probably not going to be the same allocation when you're 25 as it will be when you're 70 in retirement. And they can change over time, and that's fine, but we really need to know what is an appropriate asset allocation for you. So step one, identifying your time horizon. This is fairly straightforward. Figure out what age, ideally, you would like to retire. Is it 62? Is it 65? Perhaps it's 70. Maybe you like to work and don't plan on fully retiring. But for the sake of this discussion, your retirement age is when you will fully retire and not be receiving any more paychecks, okay? Take your target retirement age, let's say it's 65, minus your current age, maybe you're 40. Your time horizon is then 25 years, okay? That's your time horizon. 25 years is different than if I was 60 and planning on retiring in the next 2 to 5 years. We have different investor profiles, but it's important to first realize what your time horizon is. The second fundamental is identifying your risk tolerance. I mentioned earlier, do you watch the news every night? Do you check your statement every day online? If those are things that worry you and make you nervous or lose sleep at night, you're probably more of a conservative investor. Do you have confidence in our economy? Do you think corporations are profitable? Or maybe we're heading into a recession. These are things we need to take into account to figure out what is our risk tolerance. And finally, do you have a long-term outlook? Are you investing more for the 1 year, 2 year, 3 years out? Or are you a long-term investor investing for 30, 40 years towards retirement? Those are all things to consider in identifying your risk tolerance. The third step is to identify your investor profile. Do you understand the investing process? Do you want to understand the investment process? Everybody should have a basic fundamental understanding of how the process works. You don't need to be an expert at it, but you need to understand how it works and what you own and why you own it. Are you hands-off versus hands-on? Do you like to be involved in the investment selection process? Do you like to read statements and prospectuses? Or are you more hands-off and prefer to make a simple decision in the beginning and let others manage your money for you? That's important to decide too. Are you willing to ask for help? You have resources that you can reach out to help you as an investor make decisions and answer questions that you may have. And set specific goals. When is it that you want to retire? How many years out is that? Do you want to have $1 million when you want to retire? Only need $300,000. These are things that we need to figure out so we can set goals and work towards them. The last step in fundamental investing is finding an appropriate asset allocation for you. As I said earlier, nobody is the same. Everybody has a different risk profile and a different asset allocation makeup. So what is an asset allocation? Again, we mentioned for this discussion, there's really 3 main types of assets: cash, bonds, and stocks. And we need to determine what's the right blend for you. Do you understand how they work? Do you understand what a bond is? Do you understand what a stock is, how it works, and the differences between the two? Choose a diversification that makes sense for you. Again, I said nobody should ever be 100% bonds, nobody should ever be 100% stocks, but we need to narrow down on what's an appropriate blend for you. You should really review your investments annually at the minimum. I'm not a fan of going online and checking every day or even every month, but you need to know what's going on with your investments so you can make adjustments accordingly as things progress. And rebalance is necessary. Sometimes if we have a good year in the market, maybe your stock allocation has done really well, but now makes up too big of a portion of your account. Maybe we take some profits out of your stock and rebalance it to the other asset classes to manage risk. Now for an action plan. Now that we've identified your investor profile, what are the next steps? Well, if you refer to the nest egg handout, which can be found on the state's website, we can predict a scenario using assumptions. And there's a lot of moving parts here. We don't know what taxes will be like 30 years from now. We don't know what Social Security will be like 30 years from now. And we don't know when we're going to die. But we can make assumptions using historical data to give us an idea of what you might need to retire with, depending on your age and what your basic standard of living that we want to maintain. So from the nest egg handout, if your retirement goal age is 65 years old and your salary is $30,000 at retirement, again, we want to maintain your standard of living throughout your retirement, and you live to age 90, the nest egg estimate is that you need $496,000 by the time you retire to fund your retirement for the rest of your life. That's $500,000. So we need to take the steps necessary in order to get there now. So let's create a plan of action for you. How much will you need? Again, refer to the nest egg handout. What's your timeline? How many years do you have until retirement? Are you nearing retirement, or have you just started and have more time on your side to start investing? What's your risk tolerance? Are you conservative or a more aggressive investor? Important step to figure out there. And what's the savings rate? Well, that is, what's the dollar amount or the percentage of your salary that we need to dictate to your retirement savings in order for you to meet those retirement goals at the age you desire? If you would like to retire at the age of 65, and you're currently 30 years old, you have 35 years until retirement. If you're 40 and would still like to retire at the age of 65, you have 25 years to save for retirement. The key here is the sooner you start, the better you're off. I know in your early 20s and mid-20s, it's hard to think long-term about investments and retirement, but trust me, you'll thank yourself later if you start early. And if you haven't started, or you think you're maybe behind a little bit, it doesn't matter. The key is to do something now. The sooner that you start, the better off you'll be. So let's compare your risk tolerance and your savings rate. If you consider yourself more of a conservative investor, that is, you don't like volatility and you don't like looking at statements every month and perhaps you've lost money, you would be considered a conservative investor, which is fine. But historically, conservative investors have had a lower rate of return over time. This simply means that we need to save more money every month in order to meet that retirement goal. If you're aggressive, this means you're okay taking on more risk. You're okay with volatility and day-to-day fluctuations in the market. Historically, aggressive investors have enjoyed a higher rate of return over time than conservative investors. There's more volatility and greater short-term risk, but over the long term, aggressive investors have enjoyed greater rates of return. Again, there's no guarantees. No, we can't predict what the market will do a year from now or 5 years from now. But historically, it has been shown that aggressive investors in stocks compared to bonds, have had higher rates of return. If you're an aggressive investor, this means that because you have a higher rate of return over time, you have the potential to not have to save as much money per month to meet that nest egg retirement goal. And we'll go through some calculations here. If you've used the nest egg handout and determined that your goal for retirement at the age of 65 is $496,000 and your current salary is $30,000, if you start at age 30 with $0 saved for retirement and you're an aggressive investor, let's say that's an 8% rate of return on average. And we all know there's years where we won't earn 8%, and there will be years where we perhaps earn more than 8%, but on average, over time, an 8% rate of return. At age 30, This means that you have to save $240 each month from your paycheck to hit that retirement nest egg goal of $496,000. $240 a month on $30,000 salary is 9.6% of your salary, or roughly 10%. If you compare that to a conservative investor who doesn't like as much risk, let's say the average return for a conservative investor over time is 4% per year. At the age 30 with zero saved up, that same investor would need to save approximately $561 each month to hit the nest egg goal of $496,000. That's roughly 22.5% of your $30,000 salary every year. And I know me, for one, I have bills to pay and I have mouths to feed. 22% of my paycheck is a big chunk. So we need to keep those things in mind when we're building our investor profile. Let's take a look at another example of an employee who's 40 years old, is a little late to the party and starting with $0, and what they might need to save each month to make that nest egg balance of $496,000. Now, it's important to remember that $496,000 is in addition to your Social Security benefit. So in retirement, we have buckets that we can draw income from, and several of them might be retirement assets like this and Social Security. So if you're 40 years old and starting with $0 saved for retirement, and you're an aggressive investor, you can afford volatility, at an 8% rate of return, you would need to save approximately $565 each month to hit that goal. Since you started late, that $565 per month equates to over 22% of your current salary of $30,000. Conversely, if you're a conservative investor and average a rate of return of 4% per year, to hit that nest egg goal of $496,000, you would need to save $993 a month, almost $1,000 a month from each paycheck in order to hit that goal. That equates to almost 40%, nearly half of your year's salary. Again, the key is here, start early. You'll thank yourself later, and you have the potential to not put as much money aside each paycheck for retirement because you have time on your side. But again, if you are a late starter, it's okay. The important thing is to do something now, regardless how small. Next, we're going to discuss the individual investment choices that you have through the state plan. There's several different options. We're going to discuss each one briefly, going from the most conservative options to the more aggressive options. And then they have some more target date retirement options if you're more of a hands-off investor. The first investment option we'll cover is the stable value fund. This is a very conservative fund. If an investor is invested in this fund, they're more concerned about capital, preserving their principal, not losing money. They're not so much concerned about growing their money, they just don't want to lose money. The Stable Value Fund invests in guaranteed investment contracts and other similar investments. It offers stability and liquidity, but you won't see a lot of growth out of this fund. It's a poor inflation hedge. The rate of return isn't a good investment to keep up with the rate of inflation. The next investment option that you have is the Bond Index Fund. This seeks to replicate the returns of the Barclays U.S. Aggregate Index. Now, what is that? Well, it's another index to gauge performance on, comparable to the S&P 500. Although the S&P 500 is 100% stocks, the Barclays Aggregate Index is 100% bonds. This is a passively managed fund, meaning they typically will only own what is in the aggregate index, the Barclays Aggregate Index. They're not buying and selling bonds very often. It's a diversified portfolio of fixed income investments throughout the U.S. Historically, it has a higher rate of return, yet it usually isn't a good hedge against inflation. There will be years where you have negative returns in this fund. Again, there is no such thing as a risk-free investment. There will be good years in this fund. There will be some down years in this fund. But over the long term, it should have a higher rate of return than the Stable Value Fund, which we previously discussed. The next investment option is the U.S. Core Plus Bond Fund. Conversely to the previous fund, this fund is more actively managed. They're buying and selling bonds over time. It invests in a diversified portfolio across a global opportunity set. The fund is actively managed with a risk-focused approach to preserve capital while seeking to deliver attractive total return. Total return meaning capital appreciation and some income from the interest on those bonds. This typically, again, will have a higher rate of return over time than the stable value fund, but isn't a good hedge against inflation. The next investment option is the U.S. Total Stock Market Index Fund. Again, this is a passively managed fund that seeks to replicate the return of the entire U.S. stock market for publicly traded stocks. This is a little more aggressive than the bond funds which we previously addressed. It offers exposure to U.S. companies, large cap meaning large-size companies, mid-size companies, small-size companies, and it differs from the S&P 500, which solely focuses only on large-size companies. This, you get a little bit of all of them, small, mid, and large. This will be a little more aggressive again than the bond funds. You'll have good days, you'll have bad days, but over time, over the long term, you should expect to see higher rates of return than the stable value fund or the bond funds. The next investment option is the Global Equity Fund. If you recall, the previous two equity options that we discussed were primarily U.S. funds. That fund invests in only U.S. companies. The Global Equity Fund can invest in companies all over the world, including the U.S., hence the name Global Equity Fund. The fund seeks opportunities that have the potential for above-average earnings and focuses primarily on large-sized stocks. Since this fund does invest in global and foreign countries, the performance could be affected by currency values and economic or political events. This tends to be more volatile than the U.S. Historically, global and international investments tend to be more volatile than U.S. investments. However, again, there is no guarantee of future performance. There's no such thing as a risk-free investment. Investors in this fund should be prepared for slightly more volatility than the previous investments that we discussed. The next investment option is the International Equity Index. Again, the difference between international and global is that this fund cannot, by prospectus, own U.S. companies. It can only own foreign companies. It is designed to replicate as close as possible the return of the Morgan Stanley Capital International All-Country World ex-U.S. Index. Again, another fancy term for a gauge, just to see how we can compare how it's performed over time. It represents approximately 99% of the global equity opportunity set outside of the U.S. Investors in this fund should expect more volatility than the U.S. funds, which we discussed earlier, along with the bonds and the stable value fund. But over time, you should expect to receive a higher rate of return than those bond funds or the stable value fund. The next options we're going to choose are designed more for the hands-off investors. You know, we want to have an idea and understanding of what we're invested in, but we don't want to make a whole lot of the decisions. We're not comfortable doing that. We don't want to dive into the weeds with that. These are called the Life Path Index options. There's 10 different options, and they're essentially based on your retirement year, when you want to retire. The further out you have until retirement, the more aggressive the funds will be. And as you approach that retirement date, the funds automatically get more conservative. What we don't want to have happen is you be 2 years out from retirement and still be, rather aggressively invested. We have a downturn in the market like 2008, and suddenly your retirement nest egg is worth a lot less than it was as you approach retirement. So worst case scenario. These Life Path Index funds do the work for you. So as I said, as you approach retirement, they automatically get more conservative. Age ranges basically range from 2025 to 2065, your retirement year. So if you are a younger investor, and you plan on working till 2065, you might choose the 2065 Life Path Fund. Again, this will be more aggressive in the early years and then gradually shift to a more conservative investment as you approach retirement. If you're an older investor nearing retirement in your 60s, you don't probably want to select the 2065 fund. It might be too aggressive for you. You might select the 2025 Life Path Fund, which would be more conservative because your retirement date is much more near. Again, these Life Path funds are made for more of the hands-off investors. If you had previously invested in a 401k or similar plans, you might think of them as target date retirement funds. Very similar. The final investment selection we're going to discuss today is the Investor Select Fund. This fund is similar to the asset allocation used for the Nebraska's defined benefit plan as well as the cash balance plan. It typically has an allocation of approximately 65% stocks, 30% fixed income, and 5% real estate. It's broadly diversified and typically a good hedge against inflation as it seeks longer-term growth. Lastly, before I leave you, I want to cover some 7 timeless strategies to keep in mind as you go on your investment journey towards retirement. Number 1, accept that uncertainty is the rule and not the exception. There is no crystal ball. Nobody can predict what the market will do tomorrow, next month, or even next year. But history has shown us that over the long term, the markets do tend to perform. Number 2, focus on what's important and knowable. Know what your investment profile is. Know what your time horizon is. Know what your risk tolerance is. And know what your asset allocation should be. And focus on facts, not talking heads that get paid by the number of clicks they get on their website. Be patient. This is a hard one. Don't worry about day-to-day returns in the market. Focus more on month-to-month returns, year-over-year returns. We're not so concerned about what the market's doing today or tomorrow, but we're concerned about what the market will do over the long term. Engage in healthy investor behavior. That is, try to avoid emotional knee-jerk reactions. Do what the pros do. And one of the best pieces of advice I can offer is turn off the 24/7 news cycle from time to time. It can be draining and it can drive us nuts. So try to avoid hysteria, make good emotional decisions with your investments. Expect periods of disappointment. This is a tough one. There's not a lot of things we can guarantee in this industry, but I can almost guarantee you that there will be periods of time where you lose money in your investments, whether that be over a month or over a year or over several years. You will lose money in investing. There's no such thing as a risk-free investment. Expect periods of disappointment, but that's okay. Look at the long term. Number 6, have an investment strategy. If you're working with an investment advisor, that's great. You should be able to sit down with them and plan out your strategy over the long term and know how to prepare for different events and different market cycles. And lastly, set realistic return expectations. When there's good years in the market, that's great. But don't expect that to happen every single year, year over year. Expect to have negative returns. But over the long term, you should have good, solid returns if you're invested appropriately and make good investment decisions. And finally, I want to leave you with some resources available to you to help you with your investment selections. There's this video on the state's website, which is available to you. There's also the annual investment report, which I would encourage you to look at and review from time to time. That's also can be found on the state's website. Lastly, there's the nest egg handout on the state's website, which is a great resource to help you determine who you are as an investor and what you might need in retirement, your nest egg during retirement. So with that, I'd like to thank you and good luck on your retirement journey.